It happened quietly, and that's what makes it strange. Trillions moved. Banks froze. Assets were seized. Rules changed overnight. And yet, one thing that was supposed to disappear is still here, stronger than before. Bitcoin didn't vanish. It didn't collapse under regulation. It didn't die after exchange failures. It didn't fade when headlines declared it finished. If Bitcoin were fragile, this would already be over. And that's the part that should have been in the news. Because systems don't survive stress by accident. They survive because something underneath them works differently than people assume. At first, Bitcoin was treated like a toy, then like a gamble, then like a threat. Every phase came with certainty that this was the end. But certainty kept being wrong. So the question shifts, not why does Bitcoin exist, but why didn't it break when it should have? To answer that, you have to look away from price and toward behavior. For years, most people only saw the surface. Volatility, noise, speculation. They watched charts move and assumed that was the whole story. Meanwhile, something else was happening quietly. Ownership was changing. Early on, Bitcoin traded like a rumor. People chased it, sold it, mocked it, repeated the cycle. But over Chimi, the hands holding, it changed character. Short-term holders became long-term holders. Traders became allocators. Speculators became custodians. That transition doesn't show up clearly on a price chart. It shows up in how little Bitcoin moves when bad news hits. You notice this without needing to name it. Every time something fatal happened, you expected panic. And instead, selling dried up faster than before. You didn't need to be optimistic to see it. You just had to notice that fear stopped working. That's not normal behavior for a fragile asset. Now look at what else changed. Access. For years, Bitcoin was awkward to hold, technical, risky. Easy to lose. That friction kept serious capital away. Then custody matured. Then compliance frameworks appeared. Then institutions stopped asking if Bitcoin was real and started asking how to hold it safely. That's when the conversation stopped being about belief and started being about allocation. You didn't hear a bell ring when that happened. You felt it when drawdowns stopped fleshing out long-term holders. People who held Bitcoin through multiple cycles weren't waiting for excitement anymore. They were waiting for necessity. That's a very different posture. Now zoom out further. What else was happening in the world while this shift occurred? Debt expanded, interest rates became political, assets were frozen based on jurisdiction. Cash lost purchasing power quietly. None of that directly advertised Bitcoin, but all of it made neutral assets more relevant. That relevance didn't show up as hype. It showed up as patience. You saw people stop selling into rallies and stop panicking into drops. They treated Bitcoin less like a trade and more like a reserve. That distinction matters. Reserves don't move quickly. They don't chase. They don't react to headlines. They sit until pressure forces. This is where supply quietly becomes the story. Bitcoin doesn't have flexible supply. It has predictable issuance. That sounds abstract until you watch what happens when demand becomes structural. Every 4 years, new supply shrinks. Not symbolically, mechanically. At the same time, long-term holders sell less, not more. So demand doesn't need to explode to change price. It just needs to persist. That's the uncomfortable part most people miss. Bitcoin doesn't need excitement anymore. It needs consistency. And consistency is boring to watch until it isn't. This is where people usually ask about timing. But timing was never the edge. Behavior was. You didn't need to guess the exact month or year. You needed to recognize that something stopped behaving like a fad. You watched Bitcoin absorb bad news without cascading lower. You watched sellers exhaust themselves faster each cycle. You watched narratives fail to produce the same outcomes. That's when you adjusted your posture. Not emotionally, structurally. You stopped needing Bitcoin to perform every month. You stopped checking it for validation. You stopped letting volatility dictate conviction. That wasn't confidence. That was alignment. Now layer in the next shift. Public markets, Bitcoin doesn't exist in isolation anymore. It's tied to real companies, real balance sheets, real equity exposure. Look at firms like Mike. They didn't treat Bitcoin as a trade. They treated it as a treasury decision. That changed how equity markets interacted with Bitcoin exposure. Suddenly, people could hold Bitcoin without touching a wallet. That alone altered demand dynamics. Then came mining companies. Firms like Marathon Digital and Riot Platforms don't just track price. They respond to network economics, energy costs, and capital markets. As Bitcoin matures, these businesses become leveraged reflections of its long-term trajectory, not its daily noise. That adds another layer of participation, not speculation. Infrastructure. Now pause here, because this is where most explanations jump straight to price targets. They skip the uncomfortable middle. Before Bitcoin can justify numbers that sound extreme today, it had to earn something more important first. Durability. And durability is only visible after stress. Bitcoin has now lived through multiple stress regimes. Zero rates, rising rates, Bank failures, regulatory pressure, geopolitical shocks. Each one was supposed to end the story. Instead, each one filtered ownership further. That filtering process matters more than any headline, because when ownership concentrates among people who don't need to sell, price behavior changes permanently. This is why Bitcoin's future doesn't depend on convincing skeptics. It depends on how little supply remains liquid when demand becomes unavoidable. And that's not something you announce. That's something you notice after it's already happened. The question everyone keeps circling is where this leads. But before you can understand where Bitcoin might go, you have to understand why it stopped behaving like it used to. That answer isn't ideological. It's mechanical. And it's only halfway told. Once you understand that Bitcoin stopped behaving like a speculative toy, the next question becomes unavoidable. If selling pressure has structurally changed, if supply is mechanically constrained, if ownership is concentrated among people who don't need liquidity, then what actually moves the price now? This is where most people get lost, because they still look for a trigger, a headline, a catalyst, a moment. But Bitcoin doesn't move because of moments anymore. It moves because of accumulation colliding with scarcity. Think about it the way you do. Think about real estate in the city where no new land can be created. At first, prices fluctuate based on mood, fear, optimism, cycles. But once enough people decide they're not selling unless forced, price stops responding to sentiment and starts responding to pressure. Bitcoin crossed that line quietly. You saw it when rallies didn't attract the same flood of sellers. You saw it when drawdowns stopped fleshing out long-term holders. You saw it when bad news produced shrinking reactions. That wasn't resilience. That was exhaustion. Exhaustion of available supply. Now, layer in the halving dynamic. Every 4 years, issuance drops in half. Not because of policy. Not because of votes. Because of code. That matters less when demand is weak. It matters enormously when demand becomes steady. You don't need millions of new buyers. You need a relatively small, persistent flow of capital competing for a shrinking stream of new coins. That's how repricing begins. On this Chimi, the buyers aren't tourists. They're funds, they're treasuries, they're entities that don't think in weeks or quarters. That's why volatility feels different. It's still there, but it doesn't reset the structure. Now consider what happens when access widens. Spot, Bitcoin ETFs changed more than convenience. They changed behavior. They allowed people to allocate without custody, friction. They allowed institutions to move capital without rewriting their playbooks. They allowed exposure to flow through traditional channels. That doesn't create instant price explosions. It creates steady absorption. Every day, small amounts of Bitcoin are removed from the liquid market and placed into structures that aren't designed to trade in and out. That's how pressure builds invisibly. Now, connect this to equities. Companies that hold Bitcoin on balance sheets don't treat it like inventory. They don't cycle it. They don't hedge it away. MicroStrategy is the most visible example, but not the only one. Its stock doesn't just represent software anymore. It represents leveraged exposure to Bitcoin's long-term scarcity. That's why it trades differently. That's why it reacts asymmetrically. Mining companies add another layer. Firms like Marathon Digital, Riot Platforms, and CleanSpark don't just benefit from price. They respond to network economics. As Bitcoin matures, inefficient miners exit, and efficient operators consolidate. That concentrates production in fewer hands, reduces forced selling, and tightens the feedback loop between price and supply. This isn't chaos, it's maturation. Now think about what most people are waiting for. They're waiting for confirmation. They want Bitcoin to prove itself one more time before committing, but confirmation always arrives at a higher price. That's the paradox. The very thing people wait for is created by the behavior they delay. You didn't fall into that trap because you reframed the question. Instead of asking, is Bitcoin going up soon? You asked, what would make it fail from here? That's a much harder question to answer, honestly. Bitcoin would have to lose relevance. It would have to be replaced. It would have to be abandoned by long-term holders. None of that is happening. In fact, the opposite is every year, Bitcoin becomes more integrated into financial infrastructure, not louder. More. That normalization is dangerous for skeptics because it removes the drama they rely on. Bitcoin doesn't need evangelists anymore. It needs accountants. And accountants don't chase hype. They allocate to risk-adjusted asymmetry. That's why $200,000 sounds outrageous to people still anchored to old narratives. They're imagining Bitcoin as it was, volatile, fringe, speculative, But Bitcoin at scale doesn't need to replace money to justify a much higher valuation. It only needs to absorb a small fraction of capital that no longer trusts alternatives. That's where the math starts to matter. Global bond markets are enormous. Cash pools are massive. Gold remains a store of value with limitations. Bitcoin doesn't need dominance. It needs relevance. A few percentage points of reallocation in a world searching for neutral assets creates disproportionate price effects when supply is fixed. This is why comparisons to past cycles fail. Those cycles were driven by enthusiasm. This one is driven by necessity. You sensed that shift before it became obvious. You noticed that Bitcoin stopped trying to convince anyone. It simply kept operating. Blocks kept coming. Hash rate kept rising. Ownership kept consolidating. No announcements. No celebrations. Just continuity. Now ask yourself what happens when this quiet pressure meets a moment of broader instability. A banking shock. A currency event. A policy mistake. Bitcoin doesn't need to be the hero of that story. It just needs to be available. When people realize that something exists outside the system, they're questioning. Capital moves faster than explanations. That's how repricing happens. Not gradually, suddenly. And when it does, the people who positioned early don't feel smart. They feel relieved. Relieved they didn't wait for permission. Relieved they didn't need perfect timing. Relieved they focused on structure instead of noise. You didn't need Bitcoin to make sense to everyone. You needed it to make sense in a world where trust is no longer guaranteed. That world is no longer hypothetical. And that's why the final piece of this story isn't about upside. It's about inevitability. Because once scarcity meets sustained demand, price becomes a consequence, not a forecast. And the number of people argue about today only feels extreme because the mechanism behind it is still misunderstood. That misunderstanding doesn't last forever. It just lasts until pressure forces clarity. And that moment is closer than it looks. At Chisomi point, every system reaches a moment where questions stop being theoretical. Bitcoin is approaching that moment, not because of price, because of behavior. When something survives long enough, the burden of proof flips. It no longer has to explain why it exists. Others have to explain why it shouldn't. That's where Bitcoin sits now. The final phase of this story isn't driven by excitement. It's driven by acceptance. Acceptance that supply is not negotiable. Acceptance that trust is not guaranteed. Acceptance that alternatives carry risks people used to ignore. This is where people misunderstand what comes next. They imagine crowds rushing in all at once. That's not how this works. Capital moves quietly until it doesn't. Before repricing happens, allocation happens. Slowly, methodically, almost boringly. You saw this pattern elsewhere in housing markets before they ran away. In commodities before shortages were acknowledged. In equities before entire sectors were re-rated. At first, the smart money doesn't shout. It positions. Bitcoin has been in that positioning phase longer than most people realize. Now, look at what happens when positioning becomes crowded. It doesn't look crowded on social media. It looks crowded in supply metrics. It looks crowded in custody reports. It looks crowded in balance sheets. And that's exactly where Bitcoin is tightening. Coins aren't disappearing. They're becoming unavailable. That's a critical difference. Unavailable supply doesn't respond to price signals the way speculative supply does. When price rises, it doesn't rush back to market. It waits. That waiting changes everything. Now consider the people who arrive late. They don't arrive because they suddenly understand Bitcoin. They arrive because something else fails. A bank restricts withdrawals. A currency devalues faster than expected. A policy changes overnight. Bitcoin doesn't have to win an argument in those moments. It just has to exist as an alternative. That's when the math matters. A relatively small amount of capital seeking refuge can overwhelm available liquidity. This is why Bitcoin's large moves feel discontinuous. Nothing happens for a long time, then everything happens faster than explanations can keep up. That's when people ask how they missed it. They didn't miss the information. They dismissed the implications. Now look at how different assets respond to this environment. Equities tied to Bitcoin exposure don't behave like traditional tech stocks. MicroStrategy doesn't trade on earnings multiples alone anymore. It trades on balance sheet. Mining companies don't just reflect production costs. They reflect leverage to scarcity. As Bitcoin reprices, inefficient operators get wiped out and efficient ones absorb market share. That consolidation amplifies exposure. At the same time, traditional assets respond differently. Bonds struggle under inflationary pressure. Cash erodes quietly. Gold holds value but lacks portability and speed. Bitcoin doesn't replace these assets. It competes for relevance at the margin. And margins are where repricing starts. Now zoom out one final time. What would have to happen for Bitcoin not to reach levels that seem extreme today? Demand would have to vanish. Long-term holders would have to lose conviction. A superior alternative would have to emerge and gain trust faster. None of those conditions are present. Instead, the opposite is happening. Demand is becoming institutional. Holding periods are extending. Infrastructure is strengthening. This doesn't guarantee outcomes. It makes certain outcomes plausible, and markets don't move on certainty. They move on plausibility, meeting pressure. That's why people who positioned earlier don't obsess over targets. They focus on staying solvent, staying patient, staying aligned with structure. You did that. You didn't overextend. You didn't chase leverage. You didn't need constant validation. You treated Bitcoin like an insurance policy you hoped never paid out. That mindset changes everything. Because when repricing begins, it doesn't feel like victory. It feels like confirmation. Confirmation that the system behaved exactly as pressure demanded. Now think about the number everyone argues about. 200,000. It sounds dramatic because people imagine a straight line from here to there. That's not how it happens. It happens through gaps, through sudden shifts in perception. It happens because supply didn't increase when demand became unavoidable. That's not hype. That's arithmetic. Bitcoin doesn't ask to be believed. It asks to be understood. And understanding doesn't spread evenly. It spreads slowly. Then all at once, by the time the price reflects what's already changed underneath, explanations arrive too late to matter. That's when narratives scramble to catch up. That's when people reframe what they used to dismiss. That's when the same voices that called it finished start explaining why it was inevitable. But inevitability is only obvious in hindsight. Positioning happens earlier, quietly, without drama, without permission. Bitcoin has already passed the phase where survival was the question. Now the question is scale. And scale doesn't announce itself politely. It forces recognition. When that happens, the people who understood the structure don't rush. They watch because they know this wasn't about predicting the future. It was about recognizing the present before everyone else felt it. And that recognition, once pressure builds, tends to be rewarded all at once.